registration form. Please fill that out. Also, there should be a pen at your table. It's a little here if you need to scribble some notes. And then finally, at the end, there's a survey, and I'm sure I'll get high marks, so don't bother filling that out. So let's get started. As I indicated, this will be about a 25-minute, 30-minute presentation. And my name is Joe Ford. This is Ross and Joe. We are Ford Investment Properties, and what we do, we own multi-tenant centers where you would go do your banking, maybe the hardware stores. There's multi-tenants in it. But more importantly, we also own credit tenants, triple net property tenants, and that's what this is about today. Who here has an annuity or an IRA? Okay. And you buy those because you're looking for stable income, correct? Let's tell you what it is. Today I'm going to show you something. We buy and own things like Rite Aid, Dollar General, Walgreens, Taco Bell. We buy those because the following reasons. They'll never call us, we'll never call them. Great tenant, wonderful tenant. They're corporately guaranteed our lease. Any problem with the property, don't call us. Unlike our multi-tenant center, if someone moves out, we'll deal with that. If there's a roof leak, that'll be us, those types of things. Your annuity that you have, more than likely, it's the insurance company, they buy the properties that I'm talking about in large quantities. Most people don't know Walgreens, Rite Aid, Dollar General, those entities, they don't own the property. They don't want to own the property. They control the property through a long-term lease. They sell them to people like ourselves and large annuities that buy them for the stability of it. The interest rates that you would return, for example, that you would invest in, if you owned a property like that, that would run anywhere from 12 to 15% that you would earn on your money. 12 to 15%. And at the end of the year, you'll pay no tax on that income. So let me say that again. So if I invested X amount of dollars, I'm going to earn 12 to 15% on my investment. And like a stock or a bond, if I earned that kind of money, I'd get what's called a 1099. I'd have to pay a tax on that. But if I own that in real estate, which we do, you would get a K1. That means it's deferred. Doesn't mean it's exempt. It's deferred. So if I earn 14% on my $100,000, I'm not going to pay a tax on it. So that's really the premise of what we do. So we've been in business for 35 years, and we have done a host of different things. And about 10 years ago, we did our first equity raise. Today, we're not doing an equity raise. What we're simply talking to you about is that if you have an income like an annuity or a self-directed IRA, we're going to show you that comparable to what we do. Now, what we've done in the past is that we raise equity to our investors, and then we'll buy those assets with our investors, and then at some point, we pay back our investors and then we take control of the property. What we started offering about a year ago, because people would say sometimes, I'm not sure I want to be with other investors. So what this is about today is to say that, to show you, if you're thinking about buying an annuity, or if you want to convert your annuity, that's totally something up to you. You would buy the property, we would buy it for you. So you would own the property. So you would own Dollar General, it would be your property. Remember I said at the beginning, they'll never call you, you'll never call them. It's mailbox money. Now that sounds easy for somebody who's been in the business for a very long time, but I'm going to walk you through a series of steps and show you this. Now, you could look at that and say, I don't know if I'm going to put that much money up. We'll go into it with a friend, or maybe your sister or your brother. But you will see, we'll compare those to other income assets that you might buy, hands down. So the lunch you learned today is a multitude of things. The learning is that national tenants, like I just mentioned, that's really the NFL of commercial real estate. This isn't flip a house. This isn't buy an apartment building. This is what people are after. They're way overpriced, very hard to find, but when you find them, you'll pass them on to your kids. So the framework today is that we also raise equity and people come in other funds. If at the end of the presentation you say, hey, this isn't for me, I don't know that I want to buy that or put that much money into it, but I'd rather look at shares. We have another funds coming out next month. You can call us, we'd be happy to talk to you, but that's not the essence of today. So again, we do three things. We own multi-tenant centers, which we're coming out of. We buy triple net credit tenant properties, righties, those types of things. And you'll see as we go why we're buying what kind of money we make on them. And the third part about it is today is to show you, to learn and show you if you have an annuity, if you have a self-directed IRA, or if you have stocks and bonds, those are all fine things. We're going to match one of these properties against an annuities, against stocks and bonds, and I think you'll learn it is staggering, the difference. And that's the wealth that you grow through this. As I said, what we offer is a result of our experience in multi-tenant, single-tenant commercial real estate. We offer that experience and expertise. Most people don't know that you can buy a Walgreens. If you know I can buy a Walgreens, okay, where do I start? How do I look? What are those things? That's what we do. The key to any type of credit tenant property is the lease, because they personally guarantee the lease. So when we talk to our investors, we are after the property. This is not a fund where I get a fee. I'm not after the fee. I'm after ultimately the property. And as we go along, I'll keep repeating myself because I have kids. But anyway, I'll go along and I'll keep repeating myself because it's good to reinforce what we're talking about. So we're talking about NFL of real estate. We're talking about becoming wealthy through real estate. We're talking about it without having to fix a toilet or anything to that effect. And I think you'll find that when you start to see the numbers, you'll be pleasantly surprised at it. If I put in the paper that you get a 15% return on your money, you would think, what's he selling? That's what I would think. So that's why today, and I'll put it in when you come here, I'll show you. So, did you know, for example, as I said, these, just to give you an example, that these particular tenants and more don't actually own the buildings. They use the building, they rent from private owners like us, or like you, if you own the building. They would be your tenant. That actually that provides long-term stable income, which provides growth and wealth and tax deferment. Real estate's a tax play. Based on our tax codes today, don't want to send, I pay my fair share of taxes, but I don't want to send it to the state. I don't want to send it to the government. I want to do minimum to what I can do. I'm going to grow my wealth. I'm going to protect my initial investment. Am I doing that or are you doing that?
I have no idea.
Can I just ask, it's deferred until when?
The taxes are deferred until you sell a property. And we'll do a Q&A question. That's why I gave you a note. So if you got questions, write them down. So it's deferred until you sell the property. Okay, now explain to you what happened at that time. So, prior to the pandemic, for example, 2,800 new retail stores that opened, 64% of them were dollar stores. You know, Dollar Tree, Dollar General, you've seen those stores, right? The two leading discount retailers are Dollar General and Dollar Tree, which operate more than 30,000 stores. So you believe now today the dollar stores are that, they sell more food than all of the Publix outlets together. It's fascinating. They opened thousands, vastly outnumbering Walmart retailers, along with hiring more workers to meet. In 2008, the stock that beat the S&P was Dollar General, owned by KKR out of Miami. Bought Dollar General. There are 9,800 of these stores. Almost double the second highest returning in stock. The dollar store market sells more groceries than high-end stores. In the third quarter of 2019, dollar stores sold $24 billion worth of groceries, while Whole Foods sold 15. And according to Forbes, dollar stores feed more Americans than Trader Joe's and Whole Foods. This is a dollar store, right? So that's the prominence of a dollar store. Okay. Is this on our? Wait, hold on. See, Joe, you click that button, it goes to green, and you can turn it. So why own the real estate? So why would I want to own this type of real estate if it's a dollar store, if it's a Rite Aid, or if it's a bank? Why do I want to own that real estate? How do I buy that real estate, and do I want somebody calling me? Well, they won't call you. Well, how do I know what happens when they move out? I'll explain that to you. They still have to pay you, by the way. How many times have you seen like a Rite Aid's dark meaning it looks like it's abandoned? They still have to pay the rent. They move out on us. If I got 3 years left, you will pay the rent. In court, unless you repudiated all the leases nationwide, you will still pay me the rent. So for many investors, the most attractive quality of investing in single tenant net lease, as I've been talking to you about, is relative stability and passive income. I'm going to go to my mailbox and I want to pick up my check. With new leases commonly spanning 10 years, that's generally they sign a 10-year lease with you and they have options, up to 25 years, it offers predictable income. And generally, the credit tenants do a 5-year lease and every year they get a 10% bump. So you get a 10% bump. So if you get $72,000 a year, you go to $78,000 in 5 years, and they continue to pump it up. Since rental rates are defined by the lease agreement that the tenant has with you, all of the operating expenses, all of the repairs for the property is theirs, not yours. Due to the lease terms, the cash flow it's not vulnerable to tenant turnover, fluctuations, market rates, compared to property, short-term agreements. I told you, we have in Ohio multi-tenant centers. When Pennsylvania's governor closed, he closed a lot of my centers down. My tenants couldn't open. But now my national tenants, we have Citizens Bank, Taco they all stayed open. But the little guys were closed, right? But the national tenants stayed open even through the pandemic because they're what's called necessary retail. So they're allowed to stay open.